In the government budget, receipt refers to the money received by the government. These receipts can be broadly classified into capital receipt and revenue receipt based on their nature and impact on government finances. The difference between capital receipt and revenue receipt has been discussed below in detail in the article. The difference between capital receipt and revenue receipt. Capital receipt and revenue receipt are two different types of income received by government or a business. They serve different purposes and affect financial accounts in different ways. The key difference between capital receipt and revenue receipt are discussed below. Capital receipt and revenue receipt. Capital receipt and revenue receipt are two types of income received by the government or a business that they are different in their nature, purpose and effect on financial account. To understand public finance and budgeting clearly, their details are explained below. Capital receipt. Capital receipt are the money received by the government or a company from sources that have long-term effect on its finances. These are not earned from regular or day-to-day activities, they are received occasionally. They mainly arise from selling assets such as land, building, investment, or from borrowing money, which creates a liability. Since they are usually non-recurring, they cannot be treated as a regular source of income. Capital receipt affect assets or liabilities of the government and are recorded in the balance sheet, not in the income or profit statement. Example: borrowings, disinvestment proceeds, and recovery of loans by the government. Purpose of capital receipt. Capital receipts are mainly used to strengthen the financial position of the government or company. It helps in raising large funds for long-term purposes like building infrastructure, buying assets, or expanding business activities. These funds can also be used to repay old debts and reduce financial burden. In India, the government sets disinvestment targets every year to earn capital receipt and manage the fiscal deficit. Capital receipt from debt, borrowing. These receipts create a liability, meaning the amount has to be repaid in the future. Loans. When money is borrowed from banks or financial institutions. Bonds. Money raised from the public by promising repayment with interest. Debentures, long-term borrowing instrument issued at a fixed interest rate. Capital receipt not from debt. Sale of fixed assets. When a company or government sells long-term assets like land, buildings or machinery that are no longer required, the money received is treated as a capital receipt. This increases cash but reduces the value of asset in the balance sheet. Issue of equity shares. When a company raises money by selling shares to investors, it receives capital funds. This does not create a repayment burden like a loan, but it increases the company's share capital. Government grants. If a company receives financial assistance from the government for specific long-term purposes such as research, development, or expansion, it is treated as a capital receipt. Advantages of capital receipt. Capital receipt provide large funds for long-term development and investment purposes. They give financial flexibility as the money can be used to repay debts or invest in infrastructure and new projects. Sale of unused or non-essential assets help in better utilization of resources. They help in reducing liabilities when the funds are used to repay old loans, improving financial stability. Capital receipt improve the cash position and balance sheet of the government or company. They support economic growth by financing major projects like roads, railways, and public infrastructure. Revenue receipt. Revenue receipts are the money received by the government or a company from its regular day-to-day activities. These receipts come from activities like sale of goods, providing services, taxes, fees, interest, etc. They are recurring in nature, which means they are received regularly every year. Revenue receipts do not create any liability, no repayment obligation, and do not reduce asset of government or company. They are shown in the income statement or revenue account, not in the balance sheet. In the case of Government of India, examples include tax revenue, income tax, GST, custom duty, and non-tax revenue, interest receipt, dividends from PSUs, fees, and fines. Purpose of revenue receipt. Revenue receipt are the main source of regular income for the government or a company. They help in running daily activities smoothly and meeting routine expenses like salaries, pensions, subsidies, and maintenance costs. When businesses earn revenue from selling goods and services, they can expand production, improve quality, and create more jobs. When the government collects revenue through taxes and other sources, it can spend more on public services such as education, healthcare, infrastructure, and welfare schemes. Revenue received do not create any repayment burden and do not require selling assets. Since they are received regularly, they provide financial stability and support economic growth. Similarity between capital receipt and revenue receipt. Both are sources of income for the government or a company. Both result in an inflow of cash or funds. Both are recorded in the accounting books and reflected in financial statement. Both help in assessing the financial health and stability of the government or organization. Funds received from both can be used for development, growth, and achieving economic objectives. Both arises from financial transactions between economic entities.